Last week, the Federal Reserve Bank said that they're thinking about cutting interest rates starting this September. But do you know who literally can't wait for the Fed to start cutting interest rates? Oh yeah, I got a whole list of people. You got realtors, mortgage bankers. That's not what I meant. There are some obvious industries that would benefit if interest rates go down, like realtors and mortgage brokers and car dealerships. But there's one industry that has had their eyes on what the Federal Reserve Bank is doing more than what you might think. Banks. And not because of why you might be thinking. Most people assume that banks want lower interest rates, that way they can issue more mortgages and more home equity lines of credit, which is true, but that's not their biggest concern right now. The real reason why banks have had their eye on what the Federal Reserve Bank is doing is because they're concerned about commercial real estate landlords defaulting on their $1 trillion+ of debt. And they're also concerned about big corporations defaulting on their $1 trillion+ of debt. Here's how banks make money. They lend you money, and then you have to pay this money back to the bank plus interest. So the bank makes money through this interest that you pay back. But if you go into default, you declare bankruptcy, that means not only are you not paying this interest back to the bank, but the money that the bank lent you also is gone as well. And that's the concern, because we've been seeing a rise in potential commercial real estate defaults and also a rise in corporate defaults as well. We've seen this happen before. We all remember the Silicon Valley Bank collapse that happened not that long ago. Well, Silicon Valley Bank was in the business of lending money to startups. And as interest rates went up, the valuation of the startups went down, and more startups started to go bankrupt. Now, of course, part of the reason why Silicon Valley Bank collapsed was because people started to run to the banks and pull their money out. But the reason why they were doing that is because they're worried that this bank, that Silicon Valley Bank, was lending their money to these startups that were losing value or going bankrupt. And now we have to look at what's happening with commercial landlords and corporations with these higher interest rates. Now, to clarify, the issue with these higher interest rates isn't that commercial landlords and corporations have to go out and borrow money at higher interest rates. It's that for these commercial corporations, you don't get a 30-year fixed rate mortgage. You get a readjusting loan. And so everybody, commercial landlords, corporations, were refinancing their debt in 2020 and 2021 when interest rates were at their lowest levels ever. And after you refinance, you get a 3-year or 4-year or 5-year, sometimes 7-year term. Well, now what we're seeing is a huge chunk of people that are starting to see these debts readjust. So you had these low interest rates in 2020, 2021, and now these debts are starting to readjust at a much higher interest rate. And this is where banks are keeping an eye on this, because if corporations and commercial landlords have to pay a lot higher interest rates on their debts and they can't service those costs, well, that can be a problem if the bank doesn't get their money back. How much money are we talking about? Well, according to Goldman Sachs, there's $1.8 trillion of corporate debt that's readjusting in the next couple of years. And then there's another $1.5 trillion of commercial real estate debt starting to readjust. So what I want to do in this video is go over 3 things. Number 1, what's happening in the real estate market, particularly the commercial real estate market. Number 2, what's happening with corporations. And number 3, what's next? What does this mean for you? So let me start by talking about number 1, what's happening in the real estate market. But a quick reminder that on August 14th and 15th this year, I'm hosting my biggest investor summit of the year, where I'm going to be going over number 1, how our money has changed since the pandemic, and also how our money has changed over the last 5 decades. But more importantly, I'm going to be going over new financial trends and how you can find investment opportunities in today's changing economy, where we're seeing a slowing economy, where we're still seeing the higher inflation, where we're still seeing the higher interest rates. How do you build wealth in this changing economy? I'm going to be going over all of that in this free investor summit. It's live, it's virtual. If you'd like to join, all you have to do is register. Again, it's free, and I got the link for you to register down in the description below. Just make sure you do it soon, because there's a limited number of people that can actually join me live. So let me start by talking about what's happening in the real estate market. Now, there's a lot of types of office real estate. You have apartment complexes, you have retail buildings, you have strip plazas. But for the purposes of this video, I'm going to focus in on office buildings, because they're the ones that are facing the biggest issues right now. And the way the real estate buildings are valued is based off of how much income a building is generating. Now, of course, the pandemic has changed the game for office real estate completely, because before the pandemic, everybody worked in the office. During the pandemic, everybody worked from home. Now it's kind of a mix, with more and more companies saying we're going to go back into the office, but you still have a lot of offices that are sitting 20% to 50% vacant. So what does that mean? So let's assume now that this building is fully occupied and it is making $1 million a year of profit in rental income. Now this building, this office building, is making $1 million of profit. How much is this building worth? Now the valuation of this building is going to depend on something called the cap rate. The cap rate is a metric used in commercial real estate to value a building. So let's assume that this building is in a good area. It's in a nice downtown, and this follows what's called a 5 cap, meaning it is a 5% return on your money. So the way that you would calculate the value, I know this gets a little bit technical, but just follow with me, is you take this profit and then you divide it by 5% or 0.05. That means that this building is worth $20 million. How did I come up with it? You take the $1 million profit divided by 0.05, that equals $20 million. That's how much this building is worth. That means if you bought this building and it was full and you paid $20 million for it, you might have put 30% down, which is $6 million, and you finance the other $14 million. So now let's play the scenario out. You put down $6 million in equity and $14 million of debt, assuming you put 30% down. So we're being conservative here. But then something bad happened to this building, and now 35% of this building is vacant. Well, to keep things simple, if this building is 35% vacant, let's just assume that that means that your profit has fallen by 35%. It means that your profit has fallen even further because don't forget you have other expenses and other things like that, but I'm not going to focus on that. I'm just going to be very conservative and say that the profits have only fallen by 35%, which means your fallen profits are only $650,000 now. The real issue that many landlords is that they're making much smaller profits than just 35% less than what they were making before. But again, for the purposes of this example, if your profits fall by 35%, well, now what does that mean? Well, if we follow the same 5 cap, you take the $650,000 divided by 5%, that means now it's only worth $13 million. You have $14 million of debt, but it's a $13 million building. You are now underwater. But that's not even the full problem. The second part of this problem is people aren't giving you this 5% cap rate anymore because a lot of people are running away from office real estate. And so in order to sell your building, you have to give a more attractive price, which means you might not be able to give this 5%. You might have to sell it at a 6% or a 7% or an 8% cap rate. But again, let's just be very conservative here and let's assume that you can sell this building at a 6% cap rate, because people are more scared, so they need a better rate of return on their investment. Well, now if somebody needs a 6% return, that means now that this building isn't worth $13 million, it's worth less. But I'm going to, for the sake of this example, say that it's worth $11 million. So let's assume now that this building is only worth $11 million. It's actually worth a whole lot less than $11 million, but I'm going to be very generous here. But you owe $14 million on this building. And not just that, if your debt costs start to go up, well, you might not even have any profit in the deal because your debt costs might double, which means you might not actually be making any money on this deal. This is the problem. You can't sell because if you sell, you're going to have to bring millions of dollars to the closing table, which you may or may not have. And now if your debt costs start to readjust, instead of mailing in the next mortgage payment because you won't be able to afford it because you're going to have to pay out of your pocket, you might just send in the keys to the bank, which is actually what we've been seeing happen. Is we've been seeing more and more commercial real estate enter foreclosure because of this. Now, of course, it's easy to understand how this would affect the landlord because that would mean a foreclosure and they're not making money. But we're talking about the banks here because don't forget, this money was lent to the commercial real estate landlord from the bank. And if this landlord declares bankruptcy, that means not only is the bank not going to get this money back, but they're not getting paid their interest. The bank would have to take a loss on this, and that means the bank is losing money. That's why banks are kind of concerned about what's happening with interest rates, especially the banks that are holding on to these office loans, because if that landlord mails in the keys instead of a check, the bank stops making money, and these banks don't want to own the real estate. Now, what's happening with corporations is very similar to commercial real estate, just a different asset class. With corporations, the issue is some corporations leveraged a lot in 2020, 2021. Now, some of these corporations use this money to go out and finance new growth, new machinery, new something to help grow the business. Some corporations use this debt to do stock buybacks and dividends, which didn't actually produce any more income for the company. But the real issue here is if the corporation cannot produce more income to service the higher debt costs, that means this corporation is going to see shrinking profits. And so the question now is, are corporations going to be able to service these higher debt costs? And what are these higher debt costs going to be? Because we don't know what interest rates are going to look like when a corporation actually readjusts on their debt. If the interest rates start to fall, then maybe the debt costs don't rise as significantly. But this is where what you want to pay attention to is consumers' ability to spend. Because corporations survive on consumers. I mean, at the end of the day, people have to spend money at businesses for the corporations to make their payments. And this is why you've been seeing so many corporations now focus on productivity, focus on trying to make more money, because they're starting to see this new debt wave that is going to readjust, and they're going to have higher costs because of this new debt. And if they can't service these new debt costs, well, then they're going to be in big trouble, which is why so many more corporations are trying to figure out how they can make some more money and sell things during a time where Americans need discounts, because Americans are starting to feel the pain of all the inflation over the last 3 years. So this is kind of the struggle that corporations are facing with the higher debt costs, plus the high inflation. And this is why now many banks are wondering, what is the Federal Reserve Bank going to do? When will they start cutting interest rates? Which brings me to number 3. What does this mean for you? Because while lower interest rates would be good in this situation for banks to potentially prevent some defaults, there's also consequences to the lower interest rates. See, higher interest rates are good for savers. If you're sitting on cash, higher interest rates are good. Why? Because now you can actually earn some interest on your high yield savings, so you can earn some return on your savings. The second reason why it's good is because asset values generally go down when you have higher interest rates. Why? Well, when you have higher interest rates, an investor would need a better return to justify making an investment. We didn't see that happen over the last 2 years. As interest rates went up over the last 2 years, asset prices kept skyrocketing. So how does that make any sense? Well, the reason why is because people had so much cash over the last 2 years that people didn't care about the return that they were getting, because they just wanted to invest their cash. But when you look at kind of a broader range scenario, when interest rates stay higher, in order for you to make an investment, you need a better rate of return if your costs of borrowing money are higher. So for cash investors, for people that are sitting on more cash, higher interest rates are good, because that gives you more power and it gives you more leverage when it comes to you investing your money. Lower interest rates are good and bad. Lower interest rates are good when it comes to you borrowing money, because your borrowing costs are cheaper, but it also makes the cost of buying things go up. Why? Because when mortgage rates go down, more people want to buy a home. If more people are buying a home, you have more bidding wars that can push the price of homes up. Lower interest rates make it easier for people to go out and finance a car. If more people are financing cars, well, now you have to compete to buy that truck, to buy that car. So now you have less negotiating room. So lower interest rates make borrowing costs cheaper, but it makes the amount of dollars that you need go up. And so this is where we don't know what the Federal Reserve Bank is going to do. I talked about this a couple videos ago, or a few videos ago, and I'm going to change the example that I gave because I want to make it a little bit more YouTube friendly. But financial opinions are like armpits. Everybody's got a couple, and some stink more than others. See, everybody has an opinion on what the Federal Reserve Bank is going to do. They themselves said that they're going to start cutting interest rates in September. You have Wall Street that says that the Federal Reserve Bank is going to cut interest rates by 1% by the end of the year. We don't know exactly what they're going to do and how aggressive they're going to be. We don't know what's going to happen with inflation. We do know that there's an election coming this November, which could potentially influence things, although the Federal Reserve Bank keeps saying that they're not going to be influenced by this election. But what you want to understand is how you can win when markets are up and how you can win when markets are down. How can you win when inflation is high and when inflation is lower? This is what you want to be worried about. Because the reality is we're going to see craziness. We're going to see markets go up. We're going to see markets go down. We're going to see booms. We're going to see busts. We're going to see the economy grow. We're going to see the economy crash. That's a part of the system. Now, how do you win regardless of what's happening in the system? That's what financial education is all about. And that's what you want to be focused on. Building your financial education, building an investment strategy. That way now you're investing your money, and that way when markets go down, you know what to do. Maybe you're just investing more aggressively. When markets go up, you know what to do. Maybe you're looking for individual companies. Maybe you're looking for real estate. Maybe you're looking for opportunities. And when you see a good buying opportunity, you're prepared. You already have the cash to go out and invest. And this means you also got to pay attention to the financial trends. What industries do you want to invest in? What trends do you see that are going to be more valuable in 10 years or 20 years or 30 years? These are the things that you want to be studying. Now, of course, these are the things that I'm going to be going over in my investor workshop on August 14th and 15th, but this is where you want to be paying attention to what's happening. That way you can find the opportunities, because the reality is the people that build wealth are those that are financially prepared. That means you have cash put aside. It's those that are financially educated, meaning you understand how to analyze your investments. You have a financial strategy. And number three is you understand the financial trends. You know what industry you want to be investing in, because you want to be investing where the money is going, not where the money is leaving out of. After a rough Thursday, the stock market had an even rougher Friday. On Thursday, we found out that manufacturing in the United States shrank for 4 straight months, which had investors starting to worry about a recession, and we saw the stock market fall. Then on Friday, we got more bad economic news. We got the unemployment data,